Good morning, everyone. Thank you for attending our webinar series on DCF modeling brought to you by Forbury. So Forbury is a cloud-based real estate modeling tool used by transactions groups around the world. If you'd like to learn more about Forbury, get in touch via email following today's webinar. My email address is in the corner of the screen. So to kick things off, why are we putting on this series? RICS have recently published a report recommending discounted cash flows be adopted as the primary methodology for commercial real estate valuations. So we thought it was a great opportunity to put on a refresher course so people can dust off the cobwebs and learn more about DCF. In terms of what to expect, today we have Jeremy Handley on the call, Director of Polgrain Consulting, to discuss the different DCF metrics and DCF implementation considerations, which will be followed by a Q&A session. If you have any questions, feel free to jot them down in the chat window below, and we will endeavour to answer those at the end of the call. We'll also be making a recording of this session, so we'll send over a copy after we finish today. So to introduce our host, we've got Jeremy Handley. Jeremy has an extensive valuation career spanning 33 years, which includes experience as a director and part of the senior leadership team for JLL. And Jeremy is now a consultant advising PropTech companies. So Jeremy, let's start with you. The RICS review is a big one. What stands out in particular among the recommendations that have been made?
Thanks, Scott. I think you've already alluded to one of the main take-homes, which is the recommendation that people move more to DCF as a principal valuation model for investment properties. I think it's high time that the industry did that, not in all circumstances, and that's something we'll talk about later. But for me, that's the most interesting take home, although there's many other things there that are interesting for valuers and clients.
Excellent. Okay, so today's session we'll cover a bit of a refresher on DCF metrics, a summary, what an exit valuation looks like, some of the parts, outputs that matter, and then we're going to have a bit of a conversational based discussion around what some of the implementation considerations are for adopting DCF as the primary valuation methodology. Next slide, please. Okay, so a bit of a recap. For those of you that joined our session 2 weeks ago, this is where we left off. This is an example of what a really high-level cash flow would look like over a 10-year hold period. So that is an assumption that the owner of this property would own it for a duration of 10 years, and during that 10-year period would forecast net rental income, the void rate service charges that would be due when we have vacant space, and also any ground rent if it's a leasehold property. So that bottom line is that net income, and that is the line we're interested in during the hold period. At the end of that hold period, we have to make an assumption about what residual valuation there is on the property. And one approach here is to take an exit valuation, which is to flash forward to the exit date and to run an assessment, a static valuation, on one of a more traditional method on what the income is at exit date, and then to gross up the valuation at that point. So on this approach and in this example, we're assuming that the owner is going to exit on a 4% net initial yield, and there's going to be exit costs associated with realizing the net sale proceeds. So in this case, it's 1.5% of the gross value. In practice, there can be a number of considerations, including whether it's VAT exempt or not. So there's an element of complication that can come into that, but in this example, it's 1.5% of the gross value. Next slide. So bringing it all together, what this looks like in a really simple sense to kind of get to that sum of the parts or sum of the present value of cash flows is to combine the two, to bring the net income, the net sale proceeds together and project a cash flow over the hold period, including the residual value. Applying a discount factor, in this case of 8%, we can produce this discount factor line, and when we multiply the net cash flow by that discount factor, we can derive the present value of cash flows expected. So in this case, the sum of that bottom line equals £1.98 million, and that would represent the DCF valuation in this example. So that's the theory, and some outputs that matter and are relevant to a DCF methodology. The two that stand out are the net present value and the internal rate of return. Now, the net present value is a similar concept, except it usually goes and talks to deriving the net present value after the purchase price has been paid. So in this example, we're going to consider acquiring this property that we've calculated has a DCF of £1.98 million and acquiring it for an initial investment of 1.5 million. So that's the outlay we would make at the start date, at the entry valuation point, and we're expecting to generate present value £1.98 million. So the net present value would represent the difference of those two values, being the present value of future cash flows less the initial investment we're making today. Again, there's complications around this. There would be purchase costs associated with the £1.5 million. But in this very simplistic example, that net present value represents the present value difference between the initial investment and the present value of the cash flows we'd expect to derive. The internal rate of return is similar. It's a similar concept, except it works in a slightly different way. Within the assessment of £1.98 million for the property in the prior example, we had assumed a discount rate of 8%. In the internal rate of return calculation, what we're doing is we're trying to derive what the discount rate is equal to when the net present value is equal to 0. So in the example from the prior slide, the present value of cash flow has been £1.98 million on an initial investment of £1.5 million. What is the discount rate for the NPV to equal 0? So if we ran an 11.7% discount rate through the example on the prior slide, we would derive a sum of present values equal to 1.5 million, equal to the initial investment, and an NPV equals 0. So that is the internal rate of return, and is a very useful metric to compare and contrast different investment opportunities. Okay, so Jeremy, seeing all this and listening to this and considering the RICS recommendations, what do you see as some of the opportunities and challenges for the industry when adopting DCF methodology?
Well, I suppose the first thing to say, especially in the light of the RICS review, is that while I do think a shift to DCF is very worthwhile and an important thing for the industry to do, a complete overnight shift to DCF for all investment property types is unlikely to be appropriate in my view. However, a shift towards DCF, especially using DCF alongside other valuation techniques, is overdue and potentially has got a lot of benefits for clients, for advisors, for purchasers, etc. Some of the advantages are around greater transparency. Valuation is often seen as a bit of a dark art, and so with using DCF techniques, we can see far more about what the appraiser is thinking. Also, I think DCF gives a framework for much more considered advice. So because you're considering more factors, there's more scope for advisors to really think about those things and be explicit about them. I also think that there's an opportunity around risk management. We're all very conscious these days about risk management. And of course, the more that you're grooming through data and looking at property in different ways, the more likely you are to spot data errors or mistakes and so forth. And I think finally, there's a real opportunity for the valuation industry and other people using DCF to be able to engage better with other professionals, because discounted cash flow is a much more understood concept across different geographies and different disciplines. So I think there's a lot of opportunities. The challenge, and we've just seen a lot of numbers on the screen, the challenge is often around how daunted people feel about swapping to a different technique. But I think the most important thing to think about here is that valuers are already instinctively considering many of the factors which are reflected in the discounted cash flow. The real difference in my mind is that in the DCF, you're going to be much more explicit about those things. But to my mind, it's not really a different technique. It's just much more about taking those instinctive assessments that you're making and turning them into numbers in the cash flow.
Okay. So I guess based on your extensive experience, Jeremy, what advice can you provide, I guess, around when a DCF valuation should be used?
The first thing I think to think about is your appraisal technique, your valuation technique must follow the market practice for pricing of that asset. And even if that's not DCF, you can then think about using DCF as a complementary or supporting approach, particularly as a method of analysing other valuation approaches. So the first thing is, in most situations, you've got the ability to use DCF, even if it's not your main technique. There are, of course, many investments which are traded on a DCF approach already. And for those, DCF valuation approach is always going to be the most appropriate method, because that's how the market is pricing. There are many other investments, though, where a more traditional approach or a DCF is used. The market will use different approaches. And that's very often to do with the purchaser type or the situation. So again, you need to be alive to what the market's doing. And particularly in those cases where you might not be using a DCF, I think valuers should seriously consider using DCF as a check to a traditional or as analysis. You have, I think, which I'm not sure really came out in the RICS paper, but there are a group of properties which are priced on an almost entirely traditional approach, and often a more simplistic approach. We often talk about the chip shop. There's really no, I wouldn't have thought there was much point in doing a DCF. I don't think it adds anything, and market pricing is not going to be based on a DCF, certainly in the current market. So there are some properties where it's not appropriate. Trade properties, specialist properties, properties where you're modelling debt, particularly where you're modelling worth to a particular owner, I think they're always going to be DCF. But even in situations where you don't want to use DCF as your main approach, I think it is important to improve transparency and look at other data points by using a DCF.
So in contrast to the traditional approaches that you mentioned earlier for the chip shop example, what do you say is the big differences, I guess, between using a traditional methodology and DCF?
Well, I think the first thing to say is that many traditional approaches, whether it's an all-risk yield, initial yield, term reversion, hardcore, they're a fairly blunt instrument when it comes to a valuation technique, and often they're quite opaque, and often they're not used to their full extent to really reflect the characteristics of a property. For example, if you've got short leases or lots of costs. DCF is much more specific in those regards, but there are many similarities in the way the two approaches work. So moving to a DCF it should be a lot less daunting than people initially think. Many valuers are also already using what I call a hybrid approach, which is perhaps using a traditional valuation approach like term reversion or hardcore, but they're being much more explicit about the assumptions they put in, particularly in terms of the shorter term assumptions. And these things might include what happens at the end of a lease or a break. Are there voids? Are there going to be void costs? Are there going to be incentives? What about non-recoverable outgoings? They may be reflecting some of those, or even receipts if there's a break penalty or something, or refurbishment costs. So that hybrid approach means that valuers and investors are already starting to think about many of the inputs, which in a very traditional approach were all just in the yield. So DCF uses these same decisions and judgments, albeit they are applied in a more consistent basis across the property and also over time. So in a hybrid approach, you might just apply those costs and things to the first 3-4 years, quite the short term. But in a discounted cash flow, you should apply those more generally over the period of the appraisal. The fundamentals, though, of a traditional valuation and a DCF are the same. The concept is, in both cases, is to use time value of money to discount future costs and incomes back to today. In both cases, that's really what they're doing, with the exception of obviously of capital value square foot type approach. The difference really arises from how specific you are about those future events and future costs. Whereas the traditional approach is often slightly more implicit, becoming more explicit as you look at hybrid approaches, whereas the DCF requires you to be much more explicit about all of those things.
So just while we're talking about this explicit nature of the inputs that we're making and the assumptions, it'd be quite good to understand a little bit more about that. What are some of the examples that you would see as being quite important to take into account quite explicitly in a DCF?
Well, so the things we've got on the screen are probably the key differences, or the key things you need to be explicit about as compared with what I've called the hybrid approach. So a valuer is going to look at things like rental growth anyway, but they're not going to put a number on it. They're not going to factor it into the future. So I think that's one of the first things that is going to be a difference between DCF and a more traditional approach. Now, ideally, you're going to be able to get these forecasts from in-house analysis, particularly if you've got a research team, or you can buy them in, hopefully without too much difficulty. And so you do need to consider what will always be slightly more generic rental growth forecasts in the light of your local knowledge. None of DCF actually takes away from the importance of market knowledge, local market knowledge for the valuer. In fact, actually enhances the need for those things, which is, as valuers will know, a requirement of the RICS in any case. So you do have to look at and adjust things like rental growth forecasts in the light of your local knowledge and particularly the characteristics of the property. A slightly more tricky thing in most people's mind is the hold period and also the exit. So as you showed in your discounted cash flow, quite an important part of the cash flow is the exit. And implied in that is when is the exit going to be, or the hold period. And this concerns a lot of people because it very much looks into the future. The exit value, though, as your a simple example showed, can have quite a significant effect on the overall calculation because it's generally a large amount of money. And the closer it is to today, of course, from a time value of money point of view, the more effect it has on the valuation. So it does need careful consideration. So looking at the hold period, first of all, if you're a purchaser or an owner, then the hold period, and to some extent the exit price as well, will be dictated by the business plan that you've got for the property. It might be to hold the property for 5 years, refurbish it, re-let it, etc. So it will be fairly clear. For market valuations, valuers will need to understand the approach of a potential purchaser because that's what they're trying to mimic. And it's not always that clear, or you might have different approaches for different sectors of the market, all looking at the same asset. So I think one technique there is to think about moving the exit period out further. So if there isn't a clear period in which the market would choose to exit, you can push it out into the future more. And this desensitizes the overall appraisal because obviously a future receipt has a lesser effect on the overall answer than if it's much closer to today. I think there's no problem in my mind about doing that, pushing the exit out a little bit further to desensitize the overall cash flow.
Makes a lot of sense. Okay, so standing back, I guess, and I guess to bring this all together, we spoke about the opportunities, the challenges. I guess, what would you see as being kind of the first steps that a practitioner would take to really get going? Maybe someone who hasn't used DCF recently, and to really, I guess, bring DCF as a methodology to another tool in the toolkit.
Yeah, I think the first thing I'd say here is, and you've called the slide "Stand Back." With any valuation technique, the the DCF, the valuation is a calculation, it's not an opinion. And so this approach of standing back and does it make sense is important for DCF, just as it is for any other technique. Arguably more important because it particularly early on, if in your sort of DCF journey, it's possible to get a little bit lost in the technique and think too much about the technique and less about what it's telling you. So that's why we say stand back. I think in terms of steps to get more comfortable and to do what the RICS is recommending, the first step is to use DCF alongside other techniques in those markets where DCF is not necessarily the only way that people buy them. So if you're using more traditional techniques, first step is to analyze your valuations using a discounted cash flow. If you think that a DCF is the most appropriate method, but you're again trying to get comfortable with that, then using an initial yield, capital value per square foot and hardcore approaches to support your DCF is perfectly valid and useful and helps form your opinion. So the other thing to do, I think, is to consider whether the assumptions that you're putting in your DCF make sense in the light of your local knowledge. You know, shouldn't be considered a black box. So think about the voids that you're putting in, the rental growth, the exit yield, and rather than thinking of those as a purely academic exercise, do they make sense in terms of what you know about how that market is working? There's no point, for example, in using rental growth forecasts that you've been provided with and seeing a forecast for the rent going to a level which you know that market will never support because of supply coming on or lack of demand or whatever. So that's again, you know, that's a stand back and make sure that what you're putting in makes sense. DCF, like any other approach, is a calculation. It's there to help you form and articulate your opinions. It's not there to produce your opinions. So again, don't blindly accept what you're saying out of any sort of calculation. Think about it in the context of your market, and that will help you become more familiar and more trusting of it as a technique. And I think one of the main things you can do is use DCF as an analysis tool, so you become more familiar with it, moving pieces, the dynamics, and you get much more comfortable with what it's actually telling you.
We've just ticked over to the final slide, I believe. So, and it sort of builds off, I guess, our last slide around standing back and the importance of, you know, looking to augment, if you will, the DCF into existing workflows, methods, and using it to test assumptions as well. What do you see as some of the critical next steps from a practitioner's perspective to get going?
It's a very good question because, as you said, it can be daunting. I don't think there's a lot of point in just going overnight, switching everything to DCF. So it is part of a journey, albeit hopefully it's not too long a journey. As a minimum, as I've said several times, use DCF as an analysis tool where you do think that a more traditional approach is the most valid approach. This will help to improve your experience of DCF, your experience of the mechanics, the thought process, and the dynamics of the calculation. So you become a little bit more instinctive about what it's telling you. Using DCF as an analysis tool for other valuation techniques will also give you an additional point of triangulation or comparison to your main approach, so that when you're forming your opinion, you've got other data points. As I mentioned, I also think it's a useful risk management tool, particularly in more complex valuations. The more you look at the data, the more you analyze it and play with it, the more you're going to spot patterns, but also things that might be wrong. And I think also for client-facing valuers, and also owners who perhaps are reporting elsewhere, using the DCF alongside other techniques gives greater transparency, greater reporting opportunities. So apart from using it in that context, I think also people can start to think about where are they going to get this extra information from. We've talked about new inputs and new rationale, and you can start to plan that now. Where am I going to get my rental growth from? How am I going to think about and rationalize my exit valuation? So those judgments are going to have to be made, and it's a good idea to start straight away thinking about how you're going to rationalize them and where the data is going to come from, including comparable analysis. So we're going to be using in this world IRRs. Well, they don't just fall off trees. You need to start to collect that type of information, which will mean analyzing comparables on that basis. Other things in terms of first steps is think about desensitizing the exit by pushing it further out where that is appropriate. And finally, start to plan your reporting. So you're going to have extra inputs to report and extra outputs to report. And if you don't report those to your clients, then just quoting an IRR is a bit pointless if you don't understand all the constituent parts that went into it. So start to think about the reporting requirements that this move will require, and also how you articulate what that means.
Well put. Okay, I think we're on to Q&A. Thanks, Jeremy. We have one question, and it's a question close to my heart, so I'll leave Jeremy to answer it, so it's in no way biased. With the UK changing to DCF, how will that affect the market for valuation tools?
Well, I think some of the valuation tools that are available will cover DCF. There are other things that are coming on the market. So I think that there will be other valuation software that people need to look at. But I think one of the things you can really do to help make this move is to look at software that sort of turns things on its head slightly. So it prioritizes discounted cash flow, but still gives you the traditional outputs and the traditional way of looking at things, rather than taking something that's a purely traditional approach and then trying to bolt on a DCF. So if you try and turn it around the other way, I think that will also help with this change. I'm a real fan of looking at things in multiple ways. So I think flexible output, the ability to interface that software into your own systems and reporting is also really, really important.
Great. Well, that's all we have time for today. I believe that brings us to the end of our time. So I'd like to thank you, Jeremy, for joining us on today's webinar, and the insight you've shared has been highly valuable. So just a reminder, we'll be making a recording of this session available to attendees. And yeah, please get in touch if you have any questions. Thank you for joining us.
Many thanks. Bye.